Happy Thanksgiving, everybody. We are going to invert some of the things that we have previously done in the stock screening process today on open interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we take your questions and answer them the best we can. A couple announcements. The first is that this is going to be abbreviated, not only because of the holiday, but because I have Fast Money on CNBC starting at 5 p.m. Eastern Time. So I cannot go the full hour as I normally would. So we'll start with that. The other thing is that I am traveling for a speaking engagement to Florida. I will be speaking in Sarasota at the Money Show down there next Monday afternoon. So because of that, we won't be able to do open mic on that Monday the way we normally would. But we should be able to do the open mic on the normal schedule next Wednesday. So I hope you will join us for that. Okay, so in one of the things we tend to do here is talk a little bit about screening for long stock ideas. And I'm going to start with this at a high level very quickly because I can sort of punch through this on my screen with some speed. Because as many of you who have watched this before will know, this is one of the things I do every day, is just sort of take a look at what the state of the world is and whether there are things that are popping up as potential long ideas, whether there are things that were long ideas in the past now are not. One of the things that I obviously like to do is just take a large universe of big companies and ensure that they're essentially adhering to some of the high-level things that I believe are important. What are some of those things? So when we're dealing with options, one of the things we typically care about is that it's going to be a higher volatility stock, because if it's not a higher implied volatility stock, then chances it may be fine as just a straightforward long constituent, but it probably is less likely to have something compelling on the options side. So in this case, I just took 3-month implied volatility, said, okay, 30 or larger. The other thing is, of course, it's nice if it has some positive momentum. We can just start by saying greater than the 50-day would be some indication of that. A higher RSI score, all else equal, is generally going to outperform over the course of the next month, or at least that's what the data shows. Higher than the 50 generally outperforms the lower numbers. So if you took the entire universe of stocks and said, okay, I want to look at the ones that have the highest price relative to their 50, and I'm going to compare that to the stocks in that same universe that have the lowest price relative to the 50, over the ensuing 30 days, it's more likely that those are going to outperform. And of course, we care a little bit about we care a lot about valuation. Generally, when it's just screening for things on a fundamental basis, I'm looking for a PEG ratio of less than 3. You can see that out of 1,000 stocks, we're already down to 168. One of the strongest signals you can get for how a stock is likely to perform over the following 30 days is whether or not the company has had a negative or a positive revenue or earnings revision by the sell side. So you can see here, I've just said, okay, I don't want to look at any stocks that have had negative revisions. Actually, I put greater than 0, so I suppose 0 would be okay, but we'll just use greater than 0 for this one for now. And then the other thing is, as I often say, the company's got to be growing at least as fast as the economy or the real rate of inflation, whichever is greater, for me to be interested in it. For now, we can just simply say, okay, well, we want to exclude anything that's going to be less than 5%, let's say. We're down to 68 stocks in this universe. So that's a pretty good start. Now, the interesting thing is that if I'm trying to find stocks to bet against, does that mean that I can simply invert these things to find a list of stocks to short? And the answer to that is no. Unfortunately, it would be nice. These criteria that I've listed here each of these has been tested over large periods of time with a large universe of stocks and been shown to be effective in terms of identifying stocks that you might want to own, and also the timing. So this incorporates a timing element. So fundamental analysis might just create the list of stocks that you want to own, but a screen like this, which is incorporating whether or not the stock has positive momentum, for example, and also whether there have been any recent revisions, this is going to be more effective over a shorter period of time, because both the revisions and those momentum indicators tend to, they tend to have a pretty profound impact in the short term. And just to illustrate this, I'm just going to rank these factors to watch right here. But right here you can see, this is actually all stocks. I don't want that. Go. Just look at the Russell. So this is just looking at stories. But one of the things you can see is that the revisions and the price versus the 50-day, these are factors which have very, are very good hit rates, as you can see. So we're looking at hit rates of at least 75%, and as high as 92%. What is that hit rate? That is just how frequently one of these things is going to outperform. So just looking at the sales revision, which is one of my favorite indicators, we can just take a look at this. There you go. Right? So if you were long the top quintile of stocks that had positive revisions and then short the bottom quintile that had the biggest negative revisions, out of the entire Russell 1000, this is what that would have looked like. So, this is the worst month, would have been May. You would have underperformed by, what do we got here? A little over 1%. But you would have outperformed 11 out of 12 months. And this gives you a sense of what kind of outperformance you're going to get. So you can see here that if you had simply just bought the top quintile, you'd be up 17.8% for the year. And if you'd bought the bottom quintile on just that one factor, you'd be up only 2.2. So one outperformed the market, the other underperformed. All right, so that's kind of where I'm getting this kind of stuff. Now, as you can see, though, if I had used this as a criteria, on a relative basis, it did pretty well. But it still wouldn't have made money as an absolute short, right? Because it's still higher on the year. So just something to think about there, that you can take good screening criteria on the long side and use them as like a first step to identifying short stocks, but it is not sufficient to simply turn them upside down and think that you're going to make money on the short side. Please forgive me, because this being the holidays, let's see here, 1 second. Apologize. So what I like to do is use this as sort of a beginning step, and then to try to find trades which are likely to provide a little bit of a tailwind. So instead of thinking about this as, okay, we're going to now look for stocks that have revenue growth that is, let's call it less than 4. So we'll call it 4% real rate of inflation over the last year. Probably not too unrealistic. I'm going to get rid of the valuation criteria that I put in here. This is because valuation gives us a basis for stocks that we want to buy. But if you try to short stocks because you think they're, quote, overvalued, just based on some simple metric, that has not been demonstrated to provide, it's not a good timing tool for picking shorts. Is it true that stocks that trade at obscene multiples over the long run might underperform ones that are trading at more attractive PEG ratios, for example? Yeah, but you're looking at a really large universe of stocks, and it is not uncommon to find very highly valued stocks that just become even more highly valued. A lot of people would have thought Palantir was overvalued at 50 times revenues, only to watch it go to more than 110 times revenues. And that is on growing revenues. So had you been short that stock, that would be a very painful exercise. And that's part of the problem with these fast-growing companies, that you can actually lose a lot more than you can make because the stock can only go to zero, right? So I think the critical thing here is that if you're going to look at valuations, we're looking for companies that are not growing particularly fast, because companies can grow their way out of a lot of trouble. So we don't want phenomenal momentum in this case. So in this case, I want to have it trading below the 50. I'm not going to worry too much about valuation for now. We'll start to look at the universe in a moment. I'm not looking to short companies that are super fast growers, because I might end up in a situation where, it's just a high valuation business that is going to grow much faster. You'll notice that just with this short exercise, so I'm looking for high volatility so I can sell premium. I want a stock that's below the 50. This revisions thing, actually, we need to get over here, because we don't want... So I don't want positive revisions, because a positive revision, stocks tend to outperform. We can show how much that has worked. I want negative revenue revisions. I want the price to be below the 50s, because these are shorts I might be, or neutral to bearish ideas that I might be instituting at the moment. I don't want something that can grow its way out of trouble. And we end up with a list of stocks that looks a bit like this. Now, you're going to notice something when this happens, is that as a group, just going to the valuation question, there's going to be a lot of stocks on here that have actually what look like very low valuations. We're talking about, in many cases, low single digits, as you can see here. And a lot of these are companies that have very big problems. Some of like Harley Davidson, for example, they've got some secular headwinds. Harley Davidson, as a brand, appeals to a certain demographic. That demographic is aging. Their bikes are extremely expensive, and they just do not have the wind at their back. Target, I don't think I'm telling anybody who's watching anything new. This is a company that really seems to be struggling to find its way. There's some other companies in here that I think also are likely to sort of stick out. You're going to see a couple building suppliers. Masco, we've got Carrier, Lennox. I know I saw another one in here. Louisiana Pacific. So you're going to notice that one of the things that happens when you look at this list of companies is you're going to end up with companies that have identifiable sort of issues. And then we've got Caesars in here as well. So once we have done that, then I think we kind of have a place to begin for looking at some potential, again, not short ideas necessarily, but neutral, what I like to call neutral to bearish. Because as I pointed out previously, I've never run a short-only book for any length of time. We've shorted stocks plenty of times, usually on a long-short basis, but I've never run just a short book like Jim Chanos or one of these guys. You do this essentially to reduce your market beta. Maybe if you want to introduce some leverage to your best ideas, you can, get some capital by, getting a little bit on the short side. But this is, an approach that I think is probably not bad if you are looking for places where you can do things like sell call spreads. So we're going to just look at Caesars in here. Mildly bullish in the short term, fortunately, as it happens. Options play happens to agree with the assessment here. So in this case, I'm going to look for a little bit of income. And we've got the stock at 22.40. So I'm going to look at maybe selling an upside call spread. So we can perhaps sell. And again, if you have a directional thesis like this, this is a situation where you might be a little bit more aggressive with the delta of the option you are selling. Now, we're post-close now. This looks like this is probably not, reflective of the prices that we might expect to get, but let's see what happens here. Yeah, you can tell that because you're actually not really getting a whole lot more in this way. But selling perhaps the 26 calls, or if you happen to own one of these stocks and you're sort of thinking like, okay, it's caught a little bit of a bid. If it falls into a screen like this, that's when you might start considering selling off some upside against it. Now, here's something else. If you happen to own the stock and it screens to a place where you say, okay, I owned it over here back at $18 and change, and now the stock is up here at 23. So you've had a very nice run in a relatively short period of time, and you're thinking about pairing it, but then here we are, we're coming into the end of the year, and you're saying, well, gee, I don't know that I necessarily want to sell the stock here. Maybe that's not favorable from a tax perspective. One of the things that can happen is if you end up selling upside calls and you just hang on to the stock just so you can bring in a little bit of premium and you maybe sell, it is possible that if the stock goes a little bit further, you're hedged against any upside risk in that case. If you cover those calls, so this is a situation that is, not bad. You own the stock, you sold the calls, but if it does run and you can also see potentially a realized loss on the call side, you can close that out and realize the loss against other potential gains, right? So it has a benefit within the portfolio that might extend beyond simply trying to collect a little bit of extra premium, if that makes sense. So just wanted to give you guys a sense of the kinds of things, and it happens to be because I'm in the process of advising on a short fund. And, there's some other things that I like to look at, which are a lot harder to screen for. And in a meeting I was having earlier today, when somebody was saying, well, can you just give me some high-level things so I can just come up with some good short ideas? And I said, here's the problem with that. And this is why I believe they need a whole lot more work. I gave a concrete example of General Electric back in the day, but I said the problem is that management likes the financials to reflect their success. They don't like it to reflect their failures. So what that means is that if there's something going on underneath the surface that's not ideal, it's probably not going to be as readily apparent to those of us who are just doing things like looking at pro formas, or we're looking at the financial statements and we're trying to discern what's going on. It won't be as apparent if something isn't right. You have to dig into it a little bit more to figure that out. The example stock that I provided was General Electric. So General Electric, when it was a really broad conglomerate and a huge portion of the company's revenues came. So this is in the Jack Welch days, and basically the end of his tenure and the period that immediately followed. General Electric was remarkable in the sense that they had the consistency of a metronome. They would beat earnings by a penny or two every single quarter after quarter. And the beauty for them of having this big conglomerate, particularly the financial group, was that they could massage their results. I guess that's a polite way to put it, right? They could massage their results so they always got to what the street might hope for. Not too, temperature was just right. Not too hot, not too cold. And I remember when they had one of their earliest earnings disappointments, I spoke to one of my colleagues about it, and I said, there's going to be a deluge now of bad news coming out of this company. And he said, why? It was one earnings miss. I said, it's not one earnings miss. This company's been able to massage their numbers forever. And the first time that they miss, that is a sign that whatever skeletons are lying around in their financial statements, they have filled every closet and they have stuffed under every rug and piece of furniture all of those skeletons, and they have just run out of room. So the kinds of things that you're typically going to be looking for on the short side once you've initiated a simple screen like this is going to take a bit more work. What are the kinds of things that you can't, that you can't massage? You could say you can't massage revenues. In general, that is true. But just be careful about related party transactions where that happens. Because in related party transactions, you buy from me, I buy from you. There was a little of that going on during the tech bubble. Some people are kind of alleging that that's sort of what we're beginning to see in the AI space a little bit. That there's sort of, I'll invest in you and you'll buy from me, and then like this. Those kinds of circular affairs. The other thing is margins, right? So if margins are narrowing, that's a little bit problematic. So I like to keep an eye on margins and make sure that I've got decent revenue growth and margins are remaining consistent or expanding. Margin compression is always going to be a warning sign. Beyond that, also, and I don't know that this is a huge problem generally, but you also have to keep kind of an eye on CapEx and expense line items, which is to say, are expenses being treated as investment? That was kind of I think that was a problem over at WorldCom, for example. So, if you see good positive free cash flow growth at a high level, good revenue growth, and not a lot of related party transactions, and margins that are constant or improving, those are good things. The other thing is that companies that are experiencing some form of distress, their balance sheets will tend to weaken. So even if you're not looking at anything else, that's kind of like the first sign that, what's going on here. Why would that be the case? Now, you can have arguably a slightly weakening balance sheet. Meta, I think, is an example of this. Meta has obviously been investing a lot. They've had to take on some debt to do that. We've talked about it. But, so that's kind of high-level stuff. Thought you guys might find that interesting as a general sort of theme or talking point. And we will move on and take some of your questions. Okay. So, FinWest, good morning, Mike. Happy Thanksgiving to you and you. Same to you. Appreciate that. Are you in the States, I'm wondering, or are you overseas, as you often are? And another happy Thanksgiving from PC. That's Shine, thank you. Monday Morning Quarterback, same thing. Got a lot of happy Thanksgivings in here. Steve Garcia, though, says, I have a very important question. Do strategy and Bitmine immersion have a real chance of trading above MNAV in the future? Crypto seems to have bottomed short term, and these feel like variable leverage plays. This is sort of my thing with strategy. So we have looked at this thing. I do talk to and have heard from some folks who are, they really think that strategy's in trouble. I do not believe that. I feel like there is a fundamental relationship that should exist between the Bitcoin holdings and the value of this business. And, because of this, does that mean that stock can't go down any further? It doesn't mean that Bitcoin can't go down any further either. As I said, I really felt like strategy, especially if it continued to trade at its relative value to Bitcoin where it is right now. If Bitcoin got down to 74.4, I thought that would be a particularly interesting level because it broke out from there. There have been some guesstimates that the lowest cash cost miners, that's effectively what they're paying, just basically in electricity costs. So at that point, you just stop even forgetting the expense of the equipment, of the machines and everything else, that actually you are losing money by running your machines below that level. So I thought that was interesting. It's the cost basis for strategy. So there's just a whole lot of sort of magical things about that number. I'm not saying it's going to get down there, but I definitely felt like strategy would make a very compelling long against the thesis that there's a lot of folks that are shooting for that number in Bitcoin. I don't think it should trade at a big discount. Do I know that it's going to trade at a 1.5 or 2 turn, which it did once upon a time? I don't know that it's going to get back there, but do I think it can trade at a premium? And do I think the possibility that it trades at a premium is greater than the possibility that it trades at a commensurate discount? So is it more likely that strategy could trade at 1.5 times the 650,000 Bitcoin that they hold on their balance sheet, or at a 50% discount to that, which would be 50 cents? I don't think 50 cents on the dollar is going to happen. So I absolutely think that there is some convexity there. I think that on a fully diluted basis, it's about 3.2 billion. So that gets us to 50. Let's round it up and call it 3.5 and call this 50.5 in market cap. So that's $54 billion. And where did Bitcoin close today? Let's see. Or where is it now? Oops. $90,000. And again, I like to use round numbers. So that's 58.5. I mean, right here, right now, I'd buy strategy sooner than I would buy Bitcoin to play for a little bit of the convexity possibility that you're talking about. Do I think it gets to 2 times the number? I don't think it's going to get to 2 times the number anytime soon, because I think that there's a sort of a bloom off that rose. There's a lot of people who are rooting against Michael Saylor for whatever reason. You've got the whole out of the index issue that everybody's bouncing around. So there's, I'm not going to say that it's without any hair on it at all, but I do think there's a little bit of gearing here, and you're not paying a lot for it. So I like that. I like that aspect. So that's the short version. Dividend Degenerate says, all I want for Christmas is a Bloomberg terminal. Yeah, me too. If anybody wants to pay for the Bloomberg terminal, by all means. It's unfortunately not cheap, right? That's just the downside. Get a couple data feeds going into it as well. $3,000 a month is not. That's probably what you're looking at, and pretty close to that in the base case. I think without anything, you're looking at 27. I could actually do that math because I think I saw. Yeah, it's like $2,600 a month, I think. Then the tax will vary depending on your location. In my Canner days, which was several years ago, because we traded options and futures and we traded international, I remember I saw the bill for my terminal once, and I think it was like $4,600 a month at that point because of all the market data, which is, market data is just a massive expense. You can't overstate how much it was. And I can also remember that we had a lot of Bloomberg users at that firm, and our CEO was trying to negotiate aggressively and was trying to get the price down and didn't pay the bill and was trying to negotiate and say, we'd like to get a bulk discount because we got a lot of users over here. If my memory serves, the bill was something like 10 million that they were owed, and Bloomberg said no, and this went on for a little while until all of us got a message firm-wide. We all got a message that said, if we do not receive payment inside of 48 hours, your machine is being shut off. So you can imagine every trader, every salesman, every single person who had a Bloomberg terminal at the firm worldwide got that message at the same time. Like, you're going to lose it. And lose it they did. I'll let you fill in the 4-letter word. And that bill got paid very quickly. So, yeah, they don't work with you very much on the price of this thing. I have my own little issue with that right now, actually, with them, because I ended up with 2 terminals concurrently because I was switching from one payer to another, to do this, and they were going to try to bill me for both. And you can't run 2 Bloomberg terminals on the same machine at the same time, that was quite a battle. So it's a great machine. It's a great service. It is just, it is expensive. It rips my guts out to think how much money I've spent on Bloomberg since I started to use one. But it's a house. It's probably a very nice house. I mean, because what have I been? I've had this thing for well over 20 years. So, and the price actually hasn't changed that much. It has not gone up with the pace of inflation. But let's say, so it's going to be something like, I mean, probably $30,000 a year at least for, So, oh jeez, $750,000 minimum. That's, God, that's not. Yeah, you said 20 times 20,000 is 400. Now it's more like 750 when I factor in the other things that went along with it. I think the average pay rate has been north of $3,000 a month. So probably 36,000. Yeah. So yeah, to your point. Unfortunately, I have for many of those years, I had to have real time data for a wide array of assets, and that brought the cost way up. So the covered caller: is there any truth to all the strategy versus J.P. Morgan drama? J.P. Morgan really shorting strategy. So J.P. Morgan, they came out with this warning note on strategy and said that the company was likely to be pulled from the index, and that was sort of one of the things that they were saying about it. I don't know how much prop risk, and they don't actually. So I guess I don't unfortunately have access to their recommendation in here, unfortunately. But we can actually do this. Let's see. Let's see. Here we are. So this one, this is, JP Morgan's basically been making bearish remarks about them for some time. So what I just did right now was I said, I'm searching for news stories that include both MSTR and JP Morgan in it. But, it's interesting because around the same time that they are saying not so favorable things about strategy, they have said that they think that Bitcoin could be substantially higher. So, for example, here they had 126,000 target by year end. And we're well below that. Like we said, we just looked at it, it's 90,000. So they see at least that analyst's price target for Bitcoin is 40% higher than the current stock price. So I think that's kind of interesting. I don't pay. I'll tell you something else. I mean, I pay attention to analysts' revisions because analyst revisions, in general, do have meaningful predictive capabilities over, a month and a year and so on. So if you just bought stocks that were getting positive revisions, immediately following those revisions. So, you see a revision within the last 30 days and you get long positive and you buy that stock and you sell all the ones that have the worst revisions to the downside. That has demonstrable outperformance across large data sets and reasonable sets of time. But, beyond that, I only vaguely pay attention to, what the street's overall view of a stock is. And I'll say one other thing, too, which is that, you can get a situation where the sell side just loads one side of the boat way too heavily. Everybody's bullish. Everybody's bearish. If everybody is bearish, you're probably not going to see me leaning into it on the short side because it just presents too much asymmetry One little bit of a change of posture, and everybody sort of cascades, and the whole short side bet falls apart. And the same thing is true if every single person has outlandish upside price targets and estimations and everything else. Probably not a stock that I feel like buying either, and for the same reason, because there is not a whole lot more bullishness that could enter. Everybody's all the way into the trade already. Does it mean it can't go higher? No, it doesn't mean that. It's just not. It's not for me. You know, there's probably easier places to try to make a buck than being the last guy in to a really bullish trade or the last person in on the short side. Okay, so with that, I am recognizing that it is almost 2 o'clock. Yeah, so long Microsoft, yeah, sure. Microsoft it sort of ticks most of the boxes. Valuation's a little bit ticklish, but it has been now for a little while. I mean, it is sort of traded in as low as 10 times and as high as like 35 times forward. But you start talking about metronomes, they generate in a metronomic fashion. I wish I could spend more time with you guys today, but unfortunately I cannot, because I have to bounce from this video directly over to CNBC on Fast Money, which I'm going to be joining, and that's going live in 9 minutes. So unfortunately, I have to cut this one short. But I hope all of you have a happy and safe Thanksgiving for those of you who are celebrating it. And I hope you join us in 1 week at 4:15 next Wednesday, when we'll do another open mic session when I get back from Florida. Thanks for watching.